the retail trap, and the professional shift. Today, we are addressing the single biggest reason why most traders fail to remain profitable over the long term. If you look at any trading community, you will hear the same story. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. I saw a massive bullish trend. I didn't want to miss the move, so I entered buy at the top, only for the market to reverse and hit my stop loss instantly. Does this sound familiar? This is the classic FOMO trap. Most traders enter the market way too late, not because their directional bias was necessarily wrong, but because they acted on emotion rather than waiting for a structural setup. They chased the price like a predator chasing prey that has already escaped. Professional trading is the art of extreme patience. It is about the shift from being a price chaser to becoming a level waiter. Elite traders do the exact opposite of the retail crowd. They identify their key levels of interest hours or even days in advance, and then they do nothing. They wait. They wait for the market to pull back to those levels, and more importantly, they wait for the candlesticks to tell them the truth about what is happening behind the scenes. In this video, we aren't just going to look at candle shapes. We are going to master the psychology of price action. We will explore the exact candlestick patterns we use to qualify high probability entries. By the end of this video, your vision of the market will change forever. This is Candlesticks Volume 1, The Power of Stacking, Why Candlesticks Are the Ultimate Indicator. Before we break down the specific patterns, we must understand the fundamental philosophy. Why are candlesticks so important? Why not just use a line chart or a dozen lagging indicators like the RSI or MACD? The answer is simple. Candlesticks are a direct, real-time reflection of human psychology and institutional order flow. Every single candle on your screen is a record of a battle between buyers and sellers. It tells a story of who had the power, who lost it, and where the smart money is positioning themselves. If you can read a candle, you can read the minds of the people moving the market. A candlestick pattern in isolation, however, is almost useless. If you see a hammer candle in the middle of a messy range, it carries very little weight. But when that hammer forms at a major key level, a level where banks and hedge funds are likely to have their limit orders sitting, then it becomes a high probability trade signal. Our primary focus today is the double confirm, combining powerful candlestick patterns with rock-solid key levels. We look left to find historical evidence of supply and demand, and we look at the current candles to confirm if that history is going to repeat itself. This is how you stack the odds in your favor. Type 1. The long wick candle. Psychology of rejection. The first and most critical candlestick type in our arsenal is the long wick candle. In the professional world, we call this the truth teller. This candle represents a clear, violent rejection of a specific price point. Visually, it is a candle where the tail, or wick, is sticking out significantly from the body, often 2 or 3 times the length of the body itself. Remember this rule: the longer the wick, the stronger the rejection, and the better the signal. This wick is a footprint of a failed attempt by one side to break a level. It shows that buyers tried to push the market up, but they hit a wall of sell orders so massive that the price was forced all the way back down before the candle closed. Let's analyze a real-world example on the XAU/USD daily chart. When we look left, we see a clear historical point where the price was rejected previously, marked by this purple zone. This is our resistance. Now, watch as price approaches this level months later. As a retail trader, you might be tempted to short it the moment it touches the line. But as a pro, you wait. You wait for the candle to close. In this case, a massive long wick candle forms, piercing through the level but closing far below it. This tells us the failed breakout story. The bulls tried to conquer the resistance, but the bears were waiting with superior volume. This rejection is your first sign that a reversal is highly likely. Type 2. The inside bar. The calm before the storm. The second pattern we search for is the inside bar. While the long wick shows rejection, the inside bar shows a complete loss of momentum. This is a 2-candle sequence. The first candle is a large mother bar, and the second is a much smaller candle whose entire high to low range is contained within the boundaries of that mother bar. Think of the market as an athlete who has been sprinting for miles. Eventually, they need to stop and take a breath. That breath is the inside bar. It represents a state of temporary equilibrium and indecision. However, when this indecision happens at a major resistance or support level, it is often the calm before a violent storm in the opposite direction. Let's look at the XAU/USD chart for a perfect illustration. We have our established resistance level where price has bounced twice before. On the third attempt, we see an initial rejection wick, but the buyers still try to hold on. Then, the next candle forms a tiny inside bar. This is a massive red flag for anyone holding a long position. It confirms that the buyers have officially run out of gas. They couldn't even push the price 1 pip higher than the previous candle's high. When you see this stacking of initial rejection followed by a momentum loss inside bar at a key level, you have a surgical setup for a short entry. You aren't guessing the reversal. The candles are proving it to you. Type 3. The momentum candle, the smart money trigger. Identifying rejection and momentum loss is step 1. But how do we know when it's safe to actually click the button? We use the momentum candle as our final trigger. A momentum candle is a candle whose body is significantly larger than the previous candle's body. It represents a sudden, aggressive gain in strength for one side of the market. While a rejection candle is your warning, the momentum candle is your confirmation that the new move has officially started. We never enter a trade just because the price hit a level. We enter because we see the smart money actively driving the price in our direction. Let's revisit the XAU-USD chart. Price reaches our resistance zone and gives us several long wick candles. This is the market telling you, I don't want to go higher. Many traders would sell right there, but to be a secure and high win rate trader, you wait for the momentum shift. Suddenly, a large bearish candle forms, engulfing the previous small candles. This is the bears stepping into the market with massive volume. They are no longer just defending the level, they are attacking the lows. Entering at the close of this momentum candle gives you the highest probability of success because you are trading with the actual current flow of institutional money. The ultimate strategy, stacking patterns for high-quality trades. Now we come to the most important section of this masterclass, stacking. In our previous lessons, we talked about stacking, support, and resistance. But the real endgame of price action is stacking multiple candlestick signals together at a single key level. This is how you separate an okay trade from a high-quality trade. When you have 3, 4, or 5 different signals all pointing in the same direction, you are no longer gambling. You are following a mathematical certainty of probability. This is what we call confluence, and it is the secret weapon of every 7-figure trader I know. Let's break down a master example on the XAU-USD chart. Step 1. We look left and identify a clear support zone where price has reacted before. Step 2. We observe the approach. Notice how the candles start getting smaller. These are shrinking candles, showing the sellers are getting exhausted. Step 3. We get a long wick candle that touches our support and gets sucked back up. Rejection. Step 4. We see a candle color change from red to green. The bulls are taking the lead. Step 5. A massive momentum candle closes, completely swallowing the previous candles. When all 5 signals align at a major level, you have a powerhouse setup. This double action, sellers closing positions and buyers opening new ones, is the engine behind the explosive reversals we see. Building your price action toolbox. What we have shared today is just the first volume of your professional education. To truly master the markets, you must continue to build your price action toolbox. Candlesticks are the foundation, but you must also master higher time frame confluence, intraday timing, and understanding market environments, whether we are in a trending phase or a ranging phase. The more tools you have, the more refined your filter becomes. Remember, your job as a trader is not to find trades. Your job is to find reasons not to take trades. Only when a setup passes every single one of your filters do you execute. Let's look at the XAU-USD chart. We look left and identify a clear key level of support. As price returns to this level, we start counting our signals. Signal 1. Shrinking candles. Notice how the candles get smaller as they approach the zone. Signal 2. A long wick candle rejecting the support. Signal 3. A candle color change from red to green. And finally, signal 4. A momentum candle. When you combine all these signals at a major key level, you aren't just guessing. You are witnessing a double action. Sellers are closing their short positions and taking profits, while new buyers are opening long positions. This dual pressure triggers the massive reversals we see. Conclusion and call to action. Everything we've shown you today is just scratching the surface of professional price action. To truly level up, you need to build your price action toolbox. This includes understanding market conditions, time frame confluence, and intraday confirmations. The more tools you master, the more you can filter out low-quality trades. Always try to think in terms of what other buyers and sellers are doing. Candlesticks are their footprints. If you enjoyed this video and want us to make more, hit the thumbs up button and subscribe. Also, comment below and tell us what topic you want us to cover next. We read every comment to decide our future content. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.